Welcome to this explainer. Okay, let's dive right in. Today, we're unpacking what I like to call the ultimate paradox, defining the global financial landscape right now, in May of 2026. We're operating in this environment of just historic contradiction. It's this massive, profound tug-of-war between deep geopolitical fragility on one side and unprecedented, literally unbelievable technological wealth creation on the other.
So here's the exact tension we're facing. On one hand, the physical world is just getting battered by maritime blockades, kinetic warfare, and severe supply chain fracturing. But then you look at the digital world, and it's riding this unstoppable wave of artificial intelligence integration. We're talking about the S&P 500 shattering records above 7,300, and the Dow actually reclaiming that psychologically massive 50,000 mark. So the real question is, how do these two completely different realities even coexist?
To figure that out, here's our game plan for today. We'll start with the 2026 market paradox. Then, we'll look at the chaos in the physical world, followed by the AI deflationary shield. After that, we'll cover the Fed's new regime, and finally, we'll wrap up with the 2026 investor playbook.
All right, Part 1. The 2026 Market Paradox, a historic decoupling.
What's truly unprecedented here is the sheer divergence. We are currently seeing the highest global conflict risk premium since the onset of the Russia-Ukraine war, and yet equity valuations have just completely decoupled from reality. For anyone out there managing a portfolio right now, relying on old models is honestly pretty dangerous. Investors and corporate allocators are being forced to completely recalibrate their risk parameters just to navigate this dual reality. And to really understand why this recalibration is absolutely crucial, we've got to take a hard look at the grim reality unfolding in the physical world.
Which brings us to Part 2, Chaos in the Physical World, Energy and Supply Shocks.
The geopolitical theater right now is totally dominated by the deterioration of the ceasefire between Washington and Tehran. If we trace the timeline, the whole environment irreversibly shifted back on February 28th, with a joint U.S.-Israel operation. Now, there was a fragile Pakistan-mediated ceasefire established on April 8th, but diplomatic efforts unfortunately collapsed. The conflict rapidly shifted out into the maritime domain. This led to the effective paralysis of the Strait of Hormuz by April 18th, and then the subsequent U.S. Operation Project Freedom on May 4th, which was an attempt to forcefully accelerate maritime shipping.
And you guys, the macroeconomic fallout of this maritime paralysis is just immense. The initial closure of the Strait of Hormuz wiped out approximately 10 million barrels per day from the global oil supply. 10 million. That is a staggering historic supply-side energy shock. We're talking about an artery responsible for roughly 25% of the entire world's seaborne oil trade suddenly getting choked off.
Naturally, this massive energy shock fed directly into elevated manufacturing overhead and shipping logistics all around the globe. Just take a look at U.S. headline CPI, the main measure of inflation. It's pushed all the way up to 3.8%, which is a full 1.8 percentage points above the Fed's target. And the impact is even more severe in emerging markets. Get this, Turkey's central bank had to drastically hike its end of 2026 inflation target from 16% all the way to 24%. It's basically a textbook supply-driven inflation spike.
Because of all this, physical commodities are going absolutely parabolic. Gold has surged past $4,709 an ounce. That's a number that literally would have seemed like pure fiction just a few years ago. This surge reflects a massive, structural flight to safety and is a crystal-clear indicator of the geopolitical panic sweeping right through traditional physical assets.
Okay, let's pivot to Part 3, the AI deflationary shield, the market's anchor.
So, with war paralyzing global trade and inflation spiking again, why on earth isn't the equity market crashing? Well, here is the secret. Investors are treating artificial intelligence productivity gains as a literal deflationary shield. Look at this. AI investment is projected to drive approximately 40% of all S&P 500 earnings growth in 2026. This monumental growth is somehow capable of offsetting the margin compression that energy shocks usually cause. The broader economy might be hurting, for sure, but corporate America has basically built an earnings fortress. And the sheer scale of this fortress is breathtaking. Hyperscalers are currently allocating an estimated $670 billion to capital expenditures. That's a huge CapEx boom, and it's effectively insulating the technology and communication sectors from the physical supply chain constraints that are just plaguing legacy manufacturing.
But of course, this digital boom doesn't just exist in a vacuum. It requires global stability among the major powers. And this is exactly where the May 14th Beijing Summit between President Trump and Chinese President Xi Jinping becomes so critical. Despite some pretty severe warnings regarding territorial sovereignty, the summit was really characterized by a mutual recognition of strength, where economic pragmatism ultimately won out.
Let's look at the immediate outcomes of that pragmatism. China agreed to purchase 200 Boeing jets. In return, the U.S. cleared the way for 10 Chinese tech firms to purchase NVIDIA's highly advanced H200 chips. And man, that move instantly sent U.S. tech stocks soaring to fresh records. Also, crucially for that inflation problem we were just discussing, both leaders released a joint statement affirming the Strait of Hormuz must remain open, with President Xi explicitly opposing its militarization or any Iranian tolls.
Moving on to Part 4, the Fed's new regime, the Warsh transition.
Now, as global powers realign abroad, a massive domestic economic catalyst is happening exactly today, May 15, 2026. Kevin Warsh succeeds Jerome Powell as the chairman of the Federal Reserve. And the market is already furiously pricing in this transition, which folks are colloquially calling the Warsh trade. We're seeing a steepening of the yield curve, with the 30-year U.S. Treasury yield pushing above 5%. Why is that happening? Well, because the market anticipates a pivot in how the Fed views terminal interest rates, which is essentially the peak resting point for rates.
You see, Warsh subscribes to a very specific macroeconomic theory, that artificial intelligence will act as an enduring, significant disinflationary force. This core belief gives him the theoretical latitude to potentially push for lower terminal interest rates down the line, even while current headline CPI is sitting uncomfortably high at 3.8%.
So, what does a Warsh Federal Reserve actually look like? Well, confirmed in a highly partisan 54-45 Senate vote, Warsh brings some pretty radical new policy goals to the table. First off, he wants to explicitly abandon the practice of forward guidance, arguing that it artificially suppresses market volatility. Second, he plans to shrink the massive $6.7 trillion balance sheet slowly and deliberately. Third, he's vowed to maintain strict monetary independence, despite political pressures. And finally, he prefers using trimmed mean or median inflation measures over the headline data we talked about earlier.
All right, let's bring it all together in Part 5, the 2026 Investor Playbook, Synthesis and Strategy. Okay, so we've covered the physical risks and the digital tailwinds. The real question is, how do we actually play this? First, we have to acknowledge what we're calling the decentralized imperative, as traditional maritime choke points and physical energy grids reveal these severe vulnerabilities. Relying solely on legacy systems is just a profound risk right now. This crisis is really accelerating the macroeconomic necessity for decentralized physical infrastructure, or DePIN, and compute-backed stablecoins. On top of that, utilizing proof of useful work to transform excess mining energy into AI computational power is quickly becoming a critical structural hedge against these geopolitical supply-side shocks.
For a broader portfolio strategy, institutional analysis points us toward BlackRock's highly structured 3Ds approach to surviving what is a fundamentally sound but deeply susceptible macro environment. Step 1, maintain deep diversification across all asset classes. Step 2, seek durable growth. Basically, use geopolitical pullbacks to accumulate high-quality tech assets in the AI supply chain and semiconductors. And Step 3, establish downside protection using contractual fixed income. Now, regarding that fixed income, the core strategy here is dynamic patience. With the 30-year Treasury yield rising, the advice is to not make speculative duration bets, trying to guess exactly when Warsh will cut rates. Instead, the focus should be on locking in historically attractive all-in yields using short to intermediate duration corporate credit. Capturing yields exceeding 6% right now acts as a massive ballast against the wild equity market volatility we're experiencing.
Because despite all the kinetic geopolitical noise out there, it is truly amazing that the professional consensus remains decidedly pro-risk. Just look at these upgraded year-end 2026 targets for the S&P 500. We've got HSBC and Barclays at 7,650, Goldman and JP Morgan at 7,600. HSBC even notes a bull case of 8,000 if AI investments show accelerated monetization. So Wall Street is betting heavily that corporate America's earnings fortress is going to hold strong.
We are absolutely navigating an era of historic contradiction, a multipolar world of physical blockades side by side with unparalleled digital wealth. So, applying the synthesis to your own capital allocation strategy, I want to leave you with this thought. Looking at this historic decoupling, are you increasing your allocation to digital infrastructure and AI to ride the productivity wave, or are you hedging defensively against the physical chaos? It really is the defining question for investors in 2026. Thanks so much for joining me on this explainer, and I'll see you next time.